Welcome to the 3-Edge Week in Review for the week of November 10th. I'm Fritz, Folts, the Chief Investment Strategist here at 3-Edge, and joining me here once again today is Steve Cucchiaro, the CEO and Chief Investment Officer here at 3-Edge Asset Management. Today, Steve and I will discuss the idea of a market meltup, and the S&P 500, for example, has rallied hard since April, and so does this equal a market meltup? And if we are experiencing a meltup, what factors might contribute to ending the current rally? And as always, we'll discuss how investors might consider positioning or repositioning their portfolios in the current environment. Have a lot to cover today, so let's get started. So Steve, let's start by having you, if you would, describe what exactly is meant by a market melt-up.
Well, the market melt-up typically happens at the end of a long rally. You've had lots of gains in a stock market. People have been following the trend, and they've been rewarded by following the trend, and that gets other people to jump in, and that creates a self-reinforcing virtuous cycle where the trend continues. You get a lot of momentum. Those that didn't participate get jealous, and they decide to throw in the towel and jump into the market. Others have a fear of missing out if they don't continue to invest. And then finally, there are those who think, well, this has gone too far. Let's short the market. Market keeps going up. And then with their margin calls, they're forced to buy back their shorts at a loss. And that causes more buying. So there are all these different emotional factors that cause the market to melt up after the end of a long rally. Now, if you think about human nature regarding investing, as we analyze it, hasn't changed in decades or even centuries. So we keep, as human investors, keep doing the same thing over and over. Now, we all learn early on that you're supposed to buy low and sell high. But what the observation has been, and what the data shows, that you end up having these market melt-ups at the end of a long rally, and market sentiment is at its strongest, most bullish, right near the peak of a market, when people are just exuberant and the animal spirits are running and they're so excited about the money they made. And then, of course, they're mostly bearish at the bottom when they've lost a lot of money and they're despondent and they swear they'll never buy stocks again. And of course, you should flip it if you want to make money by buying low and selling high, but that's not what humans do, and we keep making the same reactions. So the sharpest gains in a rally often happen at the buying climax near the end. And as you pointed out earlier, since April, we've had tremendously sharp gains. And that's on top of a long rally that really started in March of 2009. So this has been going on for a long time. And even though people are so excited that earnings are so strong, and earnings per share of the S&P 500 index, for example, is up 4 times what it was back in 2009, the price is up 10 times. And we know that earnings per share growth and price per share growth have to equal over the long term. So we are very much in a market melt-up, and they often last longer than logic would suggest. And now some people regret taking profits. They've made a lot of money. They take profits. The market keeps going up, and then they re-enter the market. A lot of people will continue to stay in the market because they're confident that when the top comes, they'll get out right at the top. But then you get the top, you get a correction, and people say, oh, that's just another buy the dip opportunity. And it worked the last 10 times, so it's going to work again. And then they might find that, well, no, this was the real peak, and they missed they keep buying the dips, they miss the warning signs of the correction, and then they suffer. So I want to use an analogy. In our model, we analyze valuation, we analyze economic factors, we analyze this investor behavior. And rather than showing a lot of equations, I thought of another analogy I could show to the way the model and the markets are behaving right now in a market meltup, is to use a rubber band. And I hope you can see that. Fritz, you tell me if that's showing. Mm-hmm. And so the rubber band, the mathematics of the way a rubber band works is very, very close to the mathematics of the way a market melt-up works. So when markets are close to fair value, there's very little tension in the band. And the market price parallels the fair value. During a market meltup, there's all this human emotion and excitement that pushes the band to stretch farther and farther away from fair value. But as long as that force is stronger than the band trying to pull it back, the market keeps expanding. And you might have a little dip, and then it keeps expanding. And often it expands a lot longer than most people might think, just based on the fundamentals and based on fair value. But as soon as this momentum, as soon as this force that's pulling the market higher neutralizes, then what you have left is this rubber band snapping back. And this represents the extreme overvaluation. And our models show that the U.S. market has been stretched so far, the market meltup has gone so far. We are at extreme valuation levels. So Fritz, I know that you've been compiling a list of sorts, assembling a list of possible reasons or triggers that might cause this rubber band to snap back or might be perceived as early warning signals. And I think it'd be great for you to share some of that.
Sure. So, there are a number of factors that could bring this equity market rally to a halt, beginning with monetary policy and the Fed. Investors have definitely been expecting another interest rate cut at the next FOMC meeting, which is in early December, and then more to follow into 2026. However, recent public statements by Fed policymakers has definitely thrown this assumption into some doubt now. And should the Fed pause and not cut in December? And since investors are so invested in a declining interest rate environment, such an action by the Fed, that could certainly bring the equity market rally to a halt. Another potential factor could be rising credit spreads, which we talk about a lot because they could be indicative of a weakening economy. And, as you said, credit spreads are simply the difference in yield between corporate bonds and U.S. Treasuries. And since Treasuries are considered risk-free, they offer lower yields than corporate bonds. But we know that throughout economic history, widening credit spreads can be a reliable indicator of market risk. And we are starting to see maybe the first signs that credit spreads are beginning to widen out. Other factors on the list that could derail the equity market: rising inflation, which could lead to higher rates; the risk of stagflation, where you have an environment not seen since the 70s where the economy slows, but inflation remains elevated. We're also in a world of mounting government debt, which keeps accelerating, which at some point could bring out the bond vigilantes who could demand higher yields on U.S. government bonds. And of course, geopolitical uncertainty certainly seems to be ratcheting up here. So there is a pretty long list of events that could potentially trigger a downturn in this market, but we aren't going to know what that is until it actually happens. So my question to you is, well, if you want to continue to earn returns in the equity markets, but you're also afraid that you might run into a market decline, how should investors think about positioning or repositioning their portfolios in this environment?
Well, that was quite a long list of risks and early warning indicators. And our model is constantly taking in data, analyzing the data, and actively looking at these different early warning indicators and risks, and informing the investment committee anytime something starts to go out of line. So we are very, very much monitoring closer than ever, I would say, this idea that maybe a trigger might stop this market meltup. So right now, there's a saying on Wall Street. I don't know where it came from, who the quote could be attributed to, but I do recall it. And it's that bulls make money, bears make money, and pigs get slaughtered. And the meaning behind that is that sometimes, even though it's so great to participate in a big rally and make a lot of money and so on, sometimes you can stay in the party a little too long and regret taking some profits, even if you might leave some money on the table. In our models right now, just relative to even a month or two ago, are indicating an increased risk of a correction. It doesn't mean it's going to happen immediately. It doesn't mean that the market meltup can't continue for a while. but it's given us some pause. So we advocate being especially cautious with those equity markets that are the most overvalued. And right now, that would be the U.S. equity market. And we began taking steps, late last year, early this year, to reduce the allocation of U.S. equities relative to non-U.S. equities. And I think that's warranted and maybe could be continued. I also think that you talked about the Fed rate cuts or lack thereof. And the market has priced in continued set of rate cuts. And the Fed has been announcing statements that perhaps they're not so sure, and that's giving the market some pause. So if it turns out that the market is pricing in the rate cuts and the rate cuts don't happen, that could be a trigger that not only takes the stock market down, but it could take down some other assets that benefited from weak monetary policy, like even gold. And so we have been taking some profits in gold over the last few weeks, and we do think that might be warranted. Not to sell all the gold. Gold could be your best hedge against stagflation. But again, not to be greedy and to take some profits because gold has done so extremely well. So in general, it's a time to be highly diversified. It's time to build up what we call dry powder, which would be maybe a bigger allocation to treasury bills and TIPS, Treasury Inflation Protected Securities, which would be relatively safer in any correction and would be that dry powder so that when the correction does come and people are panicking and selling at the bottom, we could take advantage of those much more favorable prices by putting some of that cash and treasuries to work. So that would be my answer.
All right. Well, great. Well, Steve, thank you. Maybe a note of a bit more caution at this point. So that will do it for Steve and me for this week. We'll be back again next week with another edition of the 3Edge Weekend Review. Remember, all our videos always available on our 3Edge YouTube channel. If you know someone who you think might benefit from watching our videos, you should please feel free to share them. And in addition, if you enjoy the videos, please consider subscribing to our 3Edge YouTube channel. We'd be most appreciative. So until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.